All right, let's talk about the bond markets, and let's welcome another guest, Sonal Desai, the Franklin Templeton fixed income CIO. Before we get to the 10-year and the 30-year, Sonal, let's get your reaction to this decision by the Fed to raise rates by 25 basis points.
So I think they took, I was listening to your previous guests, and I would agree that they took what I would consider the safe route, which was to do 25 basis points. But I absolutely agree that absent what we're seeing on the geopolitical stage right now, they probably would have gone for 50. So I definitely would not rule out a faster, more front-loaded pace of rate hikes going forward. I would also not rule out, in the event that we don't see a quick enough moderation of inflation, for these dot plots not to be revised upwards as we go further forward. I could see them going up to 2% this year. Totally could expect by the end of next year looking at something closer to 3%. So I'm looking at what the Fed has done. I think it is what was needed, because it may come across as hawkish, but the Fed is enormously behind the curve at this point.
So with that in mind, then, you said in your notes that your base case remains for the intermediate and longer term, the US Treasury rates to move higher throughout 2022. What are the key factors informing that, and what sort of movement could we see?
So for me, I would see that, at least if I look at the 10-year rate, as I look towards the end of this year, I actually do think we could see 3% by the end of this year. And it's very much based on inflation. We've got to keep in mind that we are still in a situation where real rates in this country are enormously negative. So in fact, financial conditions, despite the Fed increasing rates, have only tightened moderately. They have not had a massive tightening yet. And the other factor, which I think plays into what my call is on rates, is that we continue to see a pretty healthy labor market. I don't think that we're going to see a recession in the immediate term. Looking further forward, what the Fed must be hoping to do is to get rates high before we get to an inflation. So it's in a position where, if necessary, it could stimulate the economy. So yes, I think that rates could get as high as 3% by the end of this year.
I'm glad you bring up the labor market, because the Fed, they're continuing to seek and achieve maximum employment. With regard to what their standard is for maximum employment, has that changed given the pandemic, given the number of job openings that are out there right now and the number of companies that are still looking to fill positions?
So I'd say that, we are at a stage where, as much as we look at the unemployment rate, I would actually expect the unemployment rate to go up a little bit, but for the right reasons, because the participation rate will go up. Because over the course of the pandemic, you're absolutely right, we've seen fewer people come back to the labor market than we would have hoped for at this stage. But I would see more people continuing to come back, ironically, in part because of the inflation, because inflation will force more people back into the labor market than had originally hoped, or perhaps sooner than they had hoped that they would need to come back. So, and when the participation rate goes up for short periods of time, we might actually see the unemployment rate pick up a little bit. But it would still actually end up supporting the real economy, because you would have more of the workforce in the labor market active.
We do appreciate your insights. Thank you so much. Sonal Desai there, Franklin Templeton's fixed income CIO. Thank you for your time this afternoon.
Thank you very much.